Well, good morning, everybody, or indeed potentially good afternoon or good evening, depending on where you're sitting. One of the great things about this new world of virtual conferencing is that you don't need to be physically attending an event or even on the same continent as the conference that's taking part. So wherever you're dialing in from today, we hope you're very well. On behalf of both GTR and the sponsors, we'd like to welcome you to this West Africa Trade and Investment Finance focused conference. My name is Matthew Solley. I'm part of the structured credit and political risk business at Gallagher, which is an insurance broker. My role is really to support a wide range of client groups who are investing and trading into and through developing economies. And it's my pleasure to be able to moderate this panel, which is entitled Tough Times Ahead for Trade. When I looked at the GTR advertising and promotion of this, I spotted that it referred to the continent's leading practitioners that would be providing their insights and guiding thoughts. And I'm sure that commentary was more guided, it was more directed, sorry, at the four panelists I have the pleasure of moderating than it is of myself. But we do have a really great group for you today. We've got people that are, boots on the ground in West Africa, actively involved locally. We've got those that are looking internationally, providing finance, raising liquidity. So quite a broad spectrum actually of individuals that are interested in and have direct experience, very relevant to the topics of discussion that we're going to be covering today. So without further ado, I'm going to ask each of the panelists to introduce themselves, but perhaps I could start with Christian, if that would be okay.
Yes, sure. Thank you very much for having me on the panel. Good morning, everyone. My name is Christian Karam. I head Africa Trade Finance. We are specialized in providing liquidity to banks across Africa, and I personally am covering the West African region.
Thanks so much. And Nisrin, would you be kind enough?
Good morning. Thank you, Matt. And leading practitioner, I think that's hugely complimentary, but thanks all the same. So my name is Nisrin Abouelezz. I'm the head of Africa Group for Sumitomo Mitsui Banking Corporation, based here in London. We're a bank. We're in the business of lending across multiple areas of financing. So we do project finance, trade, corporate lending, capital markets activities. And we do have presence on the ground via two rep offices, one in Joburg and one in Cairo, but we do cover the continent out of London mainly. Thank you.
Thank you so much for that. And if Mark, I could hand over to you.
All right, thank you very much. Morning, everyone. It's great to be here today. So I'm Marcellin N'Da. I'm representing the Crédit Agricole Group. We actually cover Africa out of Paris, so I'm based in Paris. And we do work with several banks across the continent. But today, obviously, we're going to talk about West Africa. So I'll be very happy to discuss with you all during the next 45 minutes. Thank you.
Okay, thanks. And last but by no means least, Mo, could I pass across to you for an introduction?
Yeah, thank you, Matthew. My name is Mobolade Ojeahere. I work out of the transaction banking function of Union Bank with a specific focus for trade and cash for our corporate and commercial clients.
Okay, that's brilliant. Thanks so much for that. So just a quick note to people that are dialing in. We don't have any specific polling questions, which is sometimes the case with these conferences. However, the chat function will be open, and I know that the GTR guys will be accumulating and aggregating the questions and sending them through. So if any of the points of discussion or topics that we raised, do trigger some thoughts, we would ask that you do send those questions in. If you're struggling though for a question, perhaps give some thought to this. If there were one key issue, if there were one key item or point that you think would be key for West Africa in terms of emerging out of this very challenging environment that we're facing globally, I think that would certainly be an interesting discussion point, and to see whether that feeds into the thinking of this broader group of panelists that we've got today. So as I say, if you're struggling for a comment, perhaps give some thought to that, just to plant a seed. I won't lead the witness anymore, but we'll now crack on with the session. What we really intend to do is take this in 3 stages. So we're going to look reflect quite quickly on how that COVID has impacted West Africa within the with the stakeholder groups that are represented. And that's really just to set the scene. I know that there's a broad awareness of that, and I'm sure that's the case with those that are dialing in, but really just to set the scene. We're then going to look and really discuss how stakeholders have responded. So what has been, the concrete action taken, what are the structures that have been used, what have been the issues that have been faced by the practitioners. And then we're going to close by taking a forward-looking view and hopefully get some insights from the panelists in that respect. And then, of course, addressing any questions that are coming through from the audience. So without further ado, perhaps we could look again, giving both a local and an international perspective on this. Mo, would you be good enough to kick off for us?
Thank you, Matthew. And I think essentially a great place to sort of provide context is that when you reflect on Nigeria and perhaps indeed the whole of West Africa, it's essentially a trade story. So with all the efforts of sovereigns locally trying to ensure that the countries are dependent on themselves in terms of manufacturing, production, and all of that, you still find out that the plant and machinery that's required, a lot of the raw materials that are required for local production still have to be imported. And quite essentially, the challenges we saw with COVID as well, and then when you come home specifically to Nigeria and look at the double whammy effect of the crash in oil prices, it was quite a tough time for businesses and financial institutions. However, one thing that was abundantly clear was that there was still an opportunity. So you saw businesses, pivoting and looking for import substitution options, backward integration, essentially very resilient sectors and portfolios, still able to ride the wave, and that sort of showed in terms of how the region has performed relative to the general broad expectations on what the impact of COVID should have been on the sub-region. So my sense is why broadly it's been a tough time for clients, tough time for banks. It's also been an opportunity, and that has shown in the resilient performances of banks and how we've sort of ridden the wave, and how customers have also navigated this storm.
Okay, thanks for that, Mo. Really appreciate it. Perhaps Nisrin, I could pass across to you just to give, if you like, an international perspective.
Thank you for that, Matt. And I do agree with what Mo has just said. But look, when I think the first thing that we all asked ourselves when the crisis or when the pandemic hit last year was, how different is this crisis from the previous ones? How, in an attempt to try and understand how the countries will react. And the difference, I think the key one was really the fact that the crisis is induced by both, or was induced by both supply and demand. That's where the shock came from. So of course that had an impact on the volumes in terms of the demand, but also on the supply of funds, where banks or lenders like ourselves took a step back just to reassess and see, right, so what can we do? What shall we do to continue our business while supporting our clients? So the focus remained on supporting the clients themselves and the key flows that were going into the countries. But when I was looking at the composition of the West African countries, if we move away a little bit from Nigeria, because it's a different giant, it's a giant in the region. And when I was looking at the impact of the pandemic, not forgetting that actually West African region and Africa in general suffered from not only a double whammy, but a triple whammy. One is the lockdown, so the local factories shutting down, to this disruption to the supply chain, and three, also the decline in oil prices. But when I look at countries like Ghana and Senegal, for instance, considering the diversified nature of their economies, really the figures, when you look at 2019 and 2020, they've not changed much. They're almost at par. So that's interesting, because that tells you that a commodity like gold, for instance, did not suffer much. So the countries continued with their activities on the trade import and export side. In Senegal, in Côte d'Ivoire, however, cocoa, cashew, cotton, you have large quantities as far as I know, sitting in warehouses, whereby the buyers are saying, let's wait a little bit, let's hold off from the export. Not because people stopped eating chocolate, it's on the contrary, but it's just the disruption to the supply chain and also where the demand was going, and also shutting down factories elsewhere. Now, Nigeria suffered more greatly than others, and that's too simply because of the oil price. So today, the profile of the commodity does play a factor and does play a role in terms of the impact and the extent of it on the countries. So the export volume, just to get the figures right, from Nigeria in 2019, they were at 67 billion, in 2020, 43 billion. And the import also side reduced because of the demand and also the introduction of some capital controls. And look, from our side as an international bank, as I said, again, the demand decelerated last year, but we continued to support our key clients, and we looked increasingly at the profile of the transaction. And of course, we did that in conjunction with various partners, but I'm sure we will touch on that in more detail later.
Okay. Nisrin, thanks so much. And I think that's actually just a useful point, because we certainly, in these sorts of discussions, and we have a conference that's focused on the whole of West Africa, it's easy sometimes to use a very broad brush and assume that the impact has been felt the same. But of course, you've got different groups of, different countries, different economies and commodities that are obviously impacted different, or have been impacted in different ways as a consequence of COVID. Marcellin, would you be kind enough to give your thoughts?
Yes, thank you, everyone. Well, I was looking at the figures of the African Development Bank for West Africa that was published in February this year. And it was said that the whole continent economies has contracted by 1.5%. And this is typically driven by Nigeria, where the economy contracted by around 3%. But the good news is that the bank is projecting that the economy will rebound back in 2021 and will grow by 3.5% for the whole region. And we have started to see that the oil price is increasing again. It's around $70 million. Well, that's the price that is projected. So that will have a big effect for countries like Nigeria, which is the powerhouse of the region. Bear in mind that the Nigerian authorities, when building the budget, considered $40 million US, for the budget construction. So at 70, it will give that country, I'll say, a good source of revenue to reverse the trend that we saw last year. So if Nigeria is performing well, I think it will drive the region's economy in a good direction, because during 2020, even though the economy suffered, but 6 countries in the region still posted positive growth. Countries like Guinea, Benin, Cote d'Ivoire, Togo, and Niger were still posting positive growth, even if it was quite moderate compared to 2019. So that is one thing, and also it's important to also mention the stimulus packages that the major economies have come up with, because the commodities of this region is, exported to those countries. So when you take the stimulus packages, so the fiscal stimulus, the monetary policies and the trade policies put together by those countries, as the IMF was saying, as of June, we're talking about 10 trillion US dollar. So that is really, really important for the West African countries, because the major economies have to keep doing well for those countries to export their commodities. And we know that in the European zone, they've come up with 1.8 trillion new stimulus package that was approved in December. And the Joe Biden administration has come up with 1.9 trillion stimulus package. That is actually the third stimulus package. China is doing likewise. So I mean, this is very important because at least it is easing financial conditions, and then it is sustaining equity market because companies have to keep operating for them to buy from the West African continent. So in a nutshell, this is what is happening, and we hope that that will play a tremendous role in terms of recovery. Thank you.
Okay, thanks for that, Marcellin. Again, great to touch upon obviously the interconnectivity and the importance of global stimulus in that respect. Christian, just focusing again quickly on just how the impact was initially felt. Are there any comments that you would raise? I know we're going to talk in a bit about some of the alternative liquidity providers or the changes you've seen, but in terms of the impact, anything to say on that side?
Yes, definitely. I would like to add, to what my friends panelists have said. It's not the first time that we see a sharp drop of commodity and the impact on West Africa. We've seen it many times, and it's like a deja vu, and we somehow now try to figure out what the outcome will be and how we will overcome this challenge. But this time it was, first, it's a global situation, and second, we didn't know how the lockdown, even though it was maybe a crunchy lockdown, but it was a lockdown, how this will impact on the corporates and then and on the balance sheet of banks. Don't forget, this happened in March. So March, we were coming from two years of stable 2 years where let's talk about financial institutions have cleaned up their balance sheet. And then this comes. So this is why, and this comes where we didn't really know the impact of the corporate, how robust they are to weather this type of lockdown. And now, rating agency were very quick to react. So you saw a lot of downgrade or a revised outlook, negative revised outlook across the region. Except maybe one or two countries where they were a bit more stable. So this definitely impacts on the liquidity, which we will talk a bit later.
Okay. Thanks so much for that. I guess won't speak for long, but just to touch, I think on the insurance market side, the initial impact was felt by honestly a pretty sharp retraction in terms of appetite for credit and certain sovereign risk at the same time. But I think that we saw that change during the course of the year, and actually the focus of the insurance market, who's covering a lot of this risk, really actually became around their support for key clients and key groups such as the DFIs and multilaterals. But conscious of time, I'm not going to say too much more than that. So really now just looking at the response, if you like, of, as we discuss, of the relevant stakeholders, be they financiers, corporates, multilateral financial institutions, etc. It would be good to look at actually, some of the concrete action that was taken, maybe some of the structures that have been employed to facilitate continued trade. And Mo, again, if I could, I'd like to just kick off with you. If you could tell us, your experience on the ground.
Okay, thanks, Matthew. And I think, one of the interesting things we saw, given, the obvious realities and the stress, was the way we sort of approached it at Union Bank. And that was basically to, be quite upfront and engage a lot of our correspondent banks as to what the realities were, and basically give them a sense, be quite open and upfront about, the nature of the portfolio, the names we had on the books, in terms of giving them comfort. So that engagement was quite important. And then we saw also that there were also folks who took a view that, look, this was an opportunity to get into the market, to get a foothold, and we saw some of those counterparties come in. And obviously create a lot of support. There were DFIs that were quite upfront and in supporting with liquidity, and basically that in itself basically enabled us to engage the correspondents, say, look, what are the issues we're dealing with here? the need to extend tenors, give comfort in terms of the repayment of the trade lines that have been used by clients, and we basically saw a willingness to engage on that basis to look at extending tenors, which in itself then lent itself to some of the options that we took to create opportunities. We also saw DFIs willing to provide credit enhancement with guarantee programs that gave comfort. We're one of only 6 banks that are involved in one of the trade guarantee finance programs in this market, and that enabled us basically to do more for some of our clients. So basically, as tough as it was, it was a combination of factors. I don't think there was a silver bullet. It was just us being upfront, engaging with correspondents, leveraging the liquidity where DFIs stepped up. There were a number of DFIs who stepped up to say, look, we will support with liquidity. There were various counterparties that were happy to come in. We saw some bilaterals done, with ourselves. So for us, it was almost sort of a strategic build-up, because if you think about the previous stress cycles that we've seen, we're taking a view that they have increasingly become shorter, and therefore we are taking a strategic view about growing our foreign currency balance sheet to be able to support with our own liquidity as well. So it was basically a combination of those options. Us supporting with our liquidity, leveraging some of the DFI support, credit enhancements to provide comfort to our counterparties, and engagements with the counterparties as well to be able to provide extended tenors for our customers, extended repayments, and without also forgetting or mentioning that the central bank also periodically came on, with various interventions, despite the challenges that were quite obvious and the stress in the economy with dwindling forex reserves. But there was a consistency with which they intervened in the market, which enabled us to say to correspondents, look, well, it might take a longer tenor, but this will be repaid. And we haven't seen, an event of default. And if you look at previous crisis as well, we've been able to ride this wave. So I think, broadly speaking, it's just largely a combination of these various factors. Yeah. And they've created opportunities as well, because what we've seen, just on a final note, is an improved appetite for Nigerian risk in the secondary market. And that in itself, at least specifically to Union Bank, has given us an opportunity to manage the various tenor pockets that we're seeing with big ticket transactions, which, if you think about it, with increased volumes of plant and machinery being imported into the country, that there are big ticket transactions being done that we're seeing, and therefore our ability to manage that with various counterparties. And I ultimately think that we'll get to a point where we will also see, trade banks being able to syndicate some of the transactions that we see and the opportunities there. So my sense is that while it's been tough, there have been opportunities. We have seen our ability to continue to be able to do transactions and to be able to provide support for our clients to ride through the wave that we've seen.
That's great. And I think that topic of, the engagement of many partnerships and stakeholders surrounding your business to enable that to happen is a key point. And I think that might lead nicely onto Christian, because obviously you were touching there, Mo, on the topic of liquidity. I think, Christian, it might be an interesting segue to talk about, some of the new streams of liquidity that you've been able to raise, and some of the approach of some, alternative funding parties would be interested to hear about.
Okay. New and very much alternative, I wouldn't say that much, because you have to understand that for the last 3-4 years, there was a general de-risking from the international banking community towards Africa, but also other emerging markets. And then for the last 2 years, you had active players, new players, regional players that have been active and developing expertise on Africa in general, and maybe more specifically on West Africa. And many of them have been also through previous crises, so they know how things have been recovered slowly. Now, from the other hand, FIs, borrowers in West Africa, have managed very well their obligations and accommodated to the international community when it comes to communication, much better communication than in the past. When it comes to reporting, to directly also showing really the details in the balance sheet, giving comfort, and also putting a plan how to recover. Now, nonetheless, international banks, international community goes back to basic when there is disruption. So we go back to the LC business. And this is, which is good, but it was not disrupted, it continued. And of course, on the, you go back to the basic, to the LC business, to the tier 1. So most likely banks that are not in the top 3, 4, 5 banks in every institution might not see the limit, might see the limit cut, and banks just focusing on the tier 1 institution in each of those countries. When you go back to the LC business, you would see a lot of also liquidity through structured LCs with the traders. You would see also more bilaterals rather than syndicated loans. And you will see more relationship financing rather than market-driven financing. Of course, this didn't happen directly. So when the COVID situation, when the drop of the commodity or the COVID situation came in March, things just picked up around June, July. I'm not saying today the situation is as usual or business as usual, no. But we see more and more capacity coming. Also, you would know that although the insurance market was shy, but they are much more open to cover West African risk. And you mentioned it earlier, the development institution have done a very quick and fantastic job because not only they did those direct lending, but also provided a lot of programs to give comfort to the international community. So no, I think in general, we are very well satisfied how so far this shortage of liquidity has been attended to.
Okay, thanks for that, Christian. And Nisrin, could I turn to you for some comments in that respect?
No, look, I agree with everything that's been said. I think the expectation at the beginning of the crisis was that things would be much worse than they actually turned out to be. And that translates into some of the growth figures that I think Mo mentioned earlier in terms of the expectation versus the actual contraction and the GDP growth as expected. Look, the African countries, they were very proactive in the measures that they took, whether in relation to the lockdown measures or whether through the various relief programs that the central banks introduced. So that gave a lot of confidence, or a certain level of confidence, to external lenders. That's one. To the local banks themselves, maybe that's because of the various cycles that they have been through over the past few years. They have managed to build resilient balance sheets. And my goodness, I mean, over the past 10, 12 years alone, we went through, 3, 4 different crises. But now the banks are more comfortable. They are more liquid. We've not had any issue with any of the repayments. So as Christian said, the banks continue to meet their obligations. Okay. So that's been really, really positive. Look, but I'm not saying that it's all rosy. My question, the question that I keep asking myself, okay, how do we prepare for when the relief programs are removed? What will happen? Because yes, they've been introduced for a year, they've been extended for another year in certain cases. What's going to happen after that? So the governments really, and the public sector, they have a huge task ahead of them to strike a balance between the health of the people, between supporting the local economies and ensuring financial stability. Because today, wherever you have financial vulnerability, that will have a huge impact on the real sector. So you can see the domino effect of that. But to date, look, it's been well managed. It's been well, and the demand has been met to a certain extent. We're starting to see that the demand is growing, and I think that's a reflection of the easing of the restrictions, and banks and lenders have become more comfortable with the situation today. But on the point of the engagement, of course, DFIs they have played and they continue to play a major role in supporting international lenders like us, who we have the appetite, we have the liquidity. We need that additional capacity, which we use via the what I call sometimes is the unfunded liquidity that we enjoy from the insurance market, that we enjoy from the DFIs. But now what I see different this time as well is that the engagement with the DFIs has not only intensified, but it's become very kind of brainstorming. So we come together, okay, so what can we do? What can we do together to actually meet the demand or to respond to what the current needs are? So look, it's been interesting. It's been an interesting experience, but we need to be mindful of what might happen next.
Okay. I mean, obviously the massive theme there is the significant impact of the DFIs. And I guess I'm interested in a couple of things. Christian made a comment earlier about the fact that there had been a period prior to COVID of de-risking within the international banking community with a view towards developing economies. And so how we marry that against your comment, Nisrin, with regards to, if you like, a bit of trust that had been built up over the way that over a period of time, banks obviously using West Africa in this context, have been able to respond to a number of challenges and have come through those. So if you could comment on that. And at the same time, do you think there's a danger in just creating another form of dependency by continuously looking to multilateral institutions, albeit that we have to mention several of these institutions are very much within the continent and within the relevant regions that they're financing?
Look, and from that angle, yes, it's true that some international banks retrenched too simply because of either for regulatory reasons or they wanted to they changed their strategies, right, to focus on their core markets. But there's always new entrants. There have been new entrants into the market, so they've been able to respond to the increasing demand. Mm-hmm. Let's not forget that the gap today, the trade finance gap in Africa, is about $120 billion. So there will always be some sort of unmet demand. Mm-hmm. And there will always be some sort of reliance on the DFIs, not complete reliance, but this partnership between the commercial banks and the multilaterals and DFIs to work together to meet this demand to a certain extent. So I don't think it's a full reliance on them. On the contrary, it's a form of partnership. One thing I'm also noticing now in terms of trends, there has been a rise in new types of DFIs, or the DFIs that exist now, they've become more active in supporting the trade finance business and the various industries. So we will continue to see some sort of evolution in terms of who the players are, mm-hmm. how the relationship with the DFIs will be. And as Christian said, that there will always be, there have been some new sources of liquidity. There have been pockets here and there. Sorry, the second part of your question, what was it?
Well, yeah, I just wonder, is there a danger of really reliance in respect on, rather than a purely commercially driven view of the financing of trade and supply chains in these relevant regions? Is there a danger of creating reliance upon quasi public sector institutions?
Okay, so my goodness, that's also a very broad topic, but just to say that with the free trade area coming on stream, the change and the way of doing business, because I think that will open up the door to manufacturing. So the types of transactions that will happen will change. The demand for financing will change. So it may go from short term to medium term to longer term in certain instances. So the partnerships that we will have, not only with the DFIs, but also with the with ECAs increasingly, which we already do now. The interest also of the commercial lenders will I think will change in a sense that, look, we can provide different solutions. We can support our clients who are going to invest in the continent. So there's always an angle to ensure that this partnership between the commercial banks, the multilaterals, the insurance market, the ECAs, the new types of suppliers of finance as well will continue.
No, good. And of course, you have to remember that at the end of the day, the goal there is in the facilitation of trade. And certainly from the commercial insurance market's perspective, you know, the capacity that was deployed during 2020 in the context of West Africa, you know, there was certainly a shift in the direction of support behind multilateral institutions to enable them to fulfill their own mandates. Marcellin, perhaps I could ask for your comments on this area.
Well, I think the panelists have said enough on this topic. What I can add is that I mean, one of the silver lining of this crisis is obviously the fact that all the major economies, so the G20, the US this time around, and China have all agreed to extend, this kind of debt relief to the African countries. I mean, 2 years ago, the US under the Trump administration was opposed to extending any type of debt relief to the African countries because, I mean, it was fearing that will push the African countries to borrow more from China, which in turn would have a negative impact on the stock of debt and so on and so forth. But this time around, everybody's agreed that the support has to be provided to the African countries in terms of the debt service initiative that the World Bank and the IMF have put up. The other MDBs are coming forth as well with the stimulus packages and so on and so forth. So this is good for the African countries and the West African countries, for trade and for the people. I think that was really, really important to do. Now we also have to, I would say, keep hoping that the price of global commodities will keep increasing. I mentioned the price of oil recently. I think aside, because I think that the African countries at the end of the day do not have enough flexibility to engage fiscal reform because they don't have enough rooms. Some of those countries came up with monetary policies to try and tackle the crisis, but they again limited. I mean, when you look at the stimulus packages that were put up across the continent, I mean, sub-Saharan Africa, only South Africa came up with a package of around 10% of their GDP, but the other countries did not have that flexibility. So they had to rely on the support of the donors and the bilateral lenders. Nigeria, Ghana, Ivory Coast, Senegal, all these countries had to go to the IMF for emergency loans. Some of them are relying on the debt service initiative, and so on and so forth. So I think that, like you said, the dependency will be still there, in my opinion, because they don't have enough room, I'll say. Because, I mean, the crisis, I mean, those countries were in crisis somehow before the sanitary crisis hit. So we're not experiencing a new thing, only that the crisis has actually exacerbated the difficult situation in which those countries were. So in my opinion, the support has to be continued somehow. I know the debt service initiative of the World Bank has been extended for 1 year again until June 2021. I read that during the World Bank spring meeting that is coming up next month, the G20 may agree to extend that again, but for how long? I mean, the question is there. So I think on top of all these things, the African countries themselves have to come up with a framework that progressively will help them get out of the woods. So this is why I believe that because they are exporting countries, so the price of global commodities has to keep increasing, and that is how they will have more liquidity. And this time, with the control and the support of the IMF and the World Bank, hope that they will come up with sound framework, sound policy, fiscal policy, sound monetary policy, sound trade policy, to be able to gradually get out of this predicament and keep the economy afloat.
Thanks for that, Marcellin. That's useful, because I think that takes us then really just conscious of time to moving on to, if you like, a forward-looking view. And I think you also touched upon the fact, differentiating South Africa as an example versus other economies. Again, not to use that, slightly too broad brush that is sometimes used about in talking about relevant economies. So I'm just really going to ask each of the panelists, for their thoughts, forward-looking views in terms of what's going to be key, what you see moving forward to take West Africa, through this situation. So perhaps I could go again to Mo first, if that would be okay.
So thank you, Matthew. And I think Mark's sort of submission, talking about the silver lining, talking about the opportunities that we see going forward, is particularly in Nigeria, on the regional continent, West Africa, and indeed the whole of Africa, I think is an increased focus on local trade. So if you think about the realities of the supply chain crisis that was created on the back of COVID, what it's then, clearly spelled out is the need for backward integration, import substitution, and all of those efforts then mean that, financial institutions such as ourselves and our various stakeholders need to be more innovative and look for solutions that will facilitate and continue to meet the needs and the demand, of the increased local trade that we see. And we started seeing that volume increase exponentially. I mean, so while our foreign trade portfolio was relatively, flat and dipped last year, on the local trade side, we saw exponential growth. And the sense is that we'll continue to see that. If you think about the challenges of making payments and settlements within the region and Africa itself, where now we've got the Africa Free Trade Agreement signed off, it basically then means that we need to look at solving these problems, facilitating them. One of the ways we've done that at Union Bank is basically leverage the local letter of credit, domesticated the letter of credit as a means of corporates being able to do business, as opposed to guarantees, which are basically a default instrument, and leveraging the letter of credit as a payment instrument to provide comfort between corporate buyers and people transacting, and just creating more throughput and enabling more improved working capital cycles for our clients. So the sense that I see and the opportunity I see is for us to do more and be more innovative in meeting client needs going forward.
Okay, thanks for that, Mo. Well, look, we're really close to running out of time. So what I want to do is, in coming back to both Nisrin and Christian, I just want to address what is the most popular question on the session, or certainly the question with the most likes. And I think it's relevant for you guys as providers of finance and arrangers of liquidity. What practical steps can local banks and companies take to open trade financing opportunities? Is counterparty transparency and data the main challenge from the perspective of foreign lenders? So perhaps, Nisrin, could I start with you and then we'll move to Christian?
Wow, that's a very good question. I'll try to answer it briefly, but absolutely. The first thing that came to mind when you were asking the question is transparency. Transparency and engagement and communication. And frankly, I've experienced that with, for instance, with the Nigerian banks, and that has been incredibly important in decision making. They've been very open, transparent, they communicated, etc. But also, I think maybe one thing, because let's not forget that the trade finance business is related to two companies buying and selling, is perhaps the local banks, they can help educate their the local companies on the importance of transparency, having implementing certain procedures and processes that are required by international lenders that lead to more transparency and openness. I think that would be the key thing that would help engender more, or increase trade flows.
Okay, thanks for that.
Now, yeah.
And Christian, from your, again, raising liquidity, what would be top of your agenda?
Yeah, I would add what Nisrin said. Although, as stated, governance at the level of the banks have improved significantly across the last 15, 20, 10 years, really good work has been done. I guess also governance is improving well on the corporate side. But what is important, if the banks are doing well the situation, we need also governance on the sovereign level, on the country level, because despite we can still find liquidity for banks, and they have created a good trust and a track record in the international community. The ratings are there, and if the sovereign is downgraded, local lenders are directly downgraded, and then the liquidity definitely, the difficulty size will decrease, and the cost will increase. So yes, governance is very important at all levels, and specifically now at the sovereign levels, with all the reforms that are yet to be implemented, that I guess the whole community are asking for those reforms.
Okay. I think we've been given the permission to run over a few minutes. So if you don't mind, I'm going to run one or two more questions by you. And Christian, I'll start with you again on this one, if I may, and then perhaps jump over to Mo. It's in regard to the very well publicised Greensill case, and obviously, the topic here really is alternative funders of trade and supply chain finance. And I think really the question to you, Christian, I think I'm coming to you because I'm thinking about, in your efforts to raise funds, raise liquidity for institutions, does this particular topic highlight the continued need for local banks engaged in trade finance transactions?
If I understand well, definitely the Greensill unfortunate situation will shy away a lot of alternative financiers. And it's not the first time. We've seen also a similar situation happening a few years back in South Africa. And this doesn't help alternative financiers. So, but would impact West Africa, if it's the topic of our panel? Not really, because what's being done on West Africa is a bit more straightforward and more on a relationship basis rather than on a platform basis.
Okay, and I'd perhaps just offer that to Mo. I'm really thinking in the context, of the valuable role that local banks play in financing trade. Do you have any comments there?
Well, I think one is the local knowledge, knowledge of the client, their trade cycles, what their needs are, what the opportunities are there. We've touched on it extensively across the panel. There are a number of opportunities we can leverage. If for example, a client is looking to bring in capital goods, either because they're extending a new product line or bringing in new plant and machinery, then perhaps we should be looking at ECA structures that potentially can accommodate the long tenors that are required for that. Basically, it's the knowledge that we have of the local environment, the underlying product, or the underlying import item or commodity, and then the ability to sort of look at the various options that are available, and be very upfront and open with all stakeholders, whether it's the foreign correspondent, or leveraging various distribution structures that can accommodate longer tenors for the customer, and then also looking at the underlining, having a better, stronger view of the underlining item, if it's an import trade transaction. So my sense is these are sort of the valuable roles that a local bank brings, a perspective that they bring in. And Nisrin touched on it earlier in terms of just educating our client base, constant client engagements, and getting them to have a better understanding of the landscape as well. And some of the challenges that we see. So my sense is these are the things that will strengthen, the trade, the trade ecosystem, and also enable us continue to do more for the clients, for our stakeholders, and keep everyone sort of fundamentally happy.
Okay. All right, thanks for that. Well, the last thing I'm going to address, I'm just going to touch upon, there were 2 or 3 questions actually related to the support from the commercial insurance market. So I don't want to leave that element unsaid. And really just to highlight the way in which the capacity is deployed, et cetera, is that significant development over the last probably 5 to 6 years has been the deployment of private insurance capacity behind public sector institutions, which includes the multilateral finance institutions and DFIs that have really stepped up to the plate. So much of the commentary that's been spoken about today. Now, that's not to say that that's an exclusive source of distribution for those institutions, but it's played an increasing role. And I think in talking to insurers ahead of this panel, certainly the sense was that there was, other than challenges with simple aggregation, driven really by improvement in commodity prices, we do expect some appetite to cautiously return during the course of this year. I would also say we surveyed the entire commercial insurance market in both July last year and January this year. And one of the interesting statistics was that we asked insurers whether they had losses that they considered specifically attributable to COVID. Now, in July, the response was 29% said yes, and absolutely remarkably, in January of this year, it was precisely 29% again said yes. And the point really being there was that there was no demonstrable negative change during the last 6 months of last year, which is when we might have expected to see some of the fallout and negative consequences. So I think that's a positive. Still concerns about maintaining the level of public sector and DFI support as absolutely key and fundamental moving forward. But actually, again, really just echoing some of the comments from the panelists, that the situation hasn't developed in some senses as negatively in the context of finance as we might have feared. So look, I think we're going to have to wrap it up and leave it there for now. So I really just say a huge thank you, firstly, to the panelists for their contributions, which I hope you as the audience found very valuable. Thanks to all of you as the audience for dialing in and listening and contributing and sharing your questions and comments. And we just wish you the best for the rest of this GTR event, and hope to see you at a physical event at some point, not in the not too distant future. So all the best for now.
Thank you.
Great, thank
you.